Welcome. In this video, what happens if we buy 30K Zbcn today? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand.
An uptrend is one of the most important building blocks in technical analysis, indicating that price movement continues upward over the long term. On a chart, this trend is typically defined by a line drawn along the lower part, showing that the price is making higher lows over time. In the situation you described, the price touches the uptrend line at regular intervals, takes support there, and then continues its upward movement. This shows that the trend is healthy and that buyers still have control. To understand the logic of an uptrend line, you need to look at market psychology. When investors believe that an asset's value will increase over time, they want to buy when the price drops. These purchases often concentrate around a certain support level. Over time, this level creates a visible line on the price chart. This is the uptrend line. Each time the price approaches this line, buyers step in, demand increases, and the price turns upward again. This cycle continues as long as the market's overall perception doesn't change. The fact that the price moves along this trend, touching it repeatedly, sends two important messages. First, the market is still bullish, meaning the overall direction is upward. Second, buyers are reacting strongly at certain levels and are not allowing the price to drop. This gives investors confidence because as long as the trend line is not broken, the upward movement is expected to continue. In technical analysis, the saying, "the trend is your friend," exists for a reason. Price tends to continue moving in the direction of the trend. One of the most important aspects of such an uptrend is that the price does not break the trend line. If it does, it could indicate that buyers are no longer strong enough and that sellers have taken control. This is why investors often pay close attention to the trend line and prefer to buy when the price touches it. This way, they open positions at lower prices while keeping risk to a minimum. For an uptrend to be considered healthy, certain criteria must be met. First, there should be at least 2 or 3 contact points. The price must have touched the line at least twice and rebounded each time. A single contact point is not enough to form a true trend line. Also, the slope of the line should not be too steep. Overly steep trends are unsustainable and usually break quickly. Ideal uptrends have a more balanced slope and can continue in the long term. In your scenario, the price moving along the trend could indicate a potentially very good buying opportunity. Investors who buy near the lower boundary of the trend can confidently aim for higher targets as long as the trend continues. Additionally, the stop-loss level can be clearly set just below the trend line, which makes risk management much easier. From a market psychology perspective, uptrends feed investors' confidence. Each time the price bounces up from the trend line, investors think it will rise again this time and are inclined to buy. This creates a self-reinforcing cycle. As long as buyers remain strong, the trend continues. However, it's important to remember this: every trend eventually breaks. That's why it's crucial to recognize when the trend is weakening. To determine whether the uptrend will continue, it's not enough to look only at the line. Trading volume, momentum indicators, and the overall market condition should also be monitored. For example, if volume increases when the price touches the trend line, it indicates that buyers are still strong. However, if volume is low at these points, it may show that buyers are weakening. If the price maintains this trend line for a long time and bounces more strongly each time it touches it, investors can even build patterns on top of the trend. For example, if a resistance line forms at the upper part of the trend, it can turn into an ascending triangle pattern. Ascending triangles often break upward and lead to strong rallies. In other words, an uptrend is not just a standalone indicator, it can also form the foundation for other patterns. In summary, the uptrend line is a highly critical tool in market analysis. As long as the price moves along this line, the trend is considered healthy and buyers are thought to be in control. This provides a major advantage for investors in terms of both strategy and risk management. As long as the trend is not broken, the upward expectation remains. But once the trend breaks, the strategy needs to be reassessed. But we cannot decide on an analysis based on trends alone. So let's take a look at other metrics as well. Stay tuned.
The cup and handle pattern is one of the most reliable and widely followed formations in technical analysis, indicating that an uptrend is likely to continue. It gets its name from its appearance. Price action on the chart forms a shape resembling the body of a cup and its handle. One of the most important features of this pattern is that the target price can be calculated almost mathematically from the depth of the cup. In the situation you mentioned, the depth of the cup shows potential to carry the price up to the 0.054 level. This could mean a significant upside opportunity compared to the current price level. Let's first look at the cup part. The formation of the cup usually begins after a long downtrend. Once the price reaches a certain bottom level, it gradually begins to recover and rises toward the previous peak level. This process develops into a rounded and smooth curve, like the body of a cup. The rounded bottom of the cup shows that market participants are slowly starting to buy again, rather than panic selling. Sharp V-shaped reversals usually indicate shorter-term moves, while rounded cups signal stronger and longer-term trends. After the cup is completed, the price typically moves sideways or slightly downward for a while. This movement forms the handle portion of the pattern. The creation of the handle is actually healthy from a technical standpoint because it allows the price to take a breather after the previous rally and lets new buyers enter the market. A slightly downward handle is natural, but it shouldn't be too deep. A very deep handle can weaken the strength of the pattern. In your scenario, the price is currently in the process of forming the cup and handle pattern. This means market participants are waiting for the cup to complete, and once the handle finishes, a new upward wave could begin. The target of the pattern is calculated simply as follows. The distance between the highest and lowest points of the cup is measured, and this distance is added to the breakout point after the handle breaks. That's why the 0.054 level you mentioned appears as an upside target equal to the depth of the cup. Here, an important psychological factor comes into play. During the cup and handle pattern, investors are generally split into two groups: those who hesitate during the formation of the handle and those who wait for the breakout moment. Once the handle breaks, a significant increase in volume is usually seen, because the waiting investors take positions, pushing the price quickly upward. Volume confirmation is one of the most critical validation signals for the cup and handle pattern. Why does this pattern work so well? The answer lies in market psychology. The first half of the cup usually represents a process where selling pressure is gradually decreasing. The upward move from the bottom shows that buyers are starting to gain strength. As the price approaches the peak, it tests the levels where it had previously fallen. At this stage, some investors take profits and the price pulls back slightly, the handle part. However, this pullback creates an opportunity for new buyers. When the handle breaks, the perception that the decline is over strengthens and the price moves sharply upward. Reaching the target price of $0.054 usually happens in several stages. The first stage is a quick spike after the breakout. Then, the price may consolidate for a while, followed by a second wave up to the target. It's important for investors to remain patient during this process, because the price does not always move toward the target in a straight line. There can be interim corrections. As you mentioned, when the target is $0.054, the potential return compared to the current price level can be quite high. This excites investors and can further increase buying pressure after the handle breaks. However, it's important to note that, like any technical pattern, the cup and handle does not provide a 100% guarantee. A stop-loss level should be set and risk management should be implemented. Another important point is the time frame of the cup and handle pattern. Formations that develop in larger time frames, daily, weekly, are generally more reliable and produce bigger price moves. In smaller time frames, the pattern can play out faster, but targets will be smaller. The scenario we have here contains one of the simplest yet most powerful calculation logics in the investment world: the difference between the quantity we hold, the current price, and the target price. In your example, we are talking about buying 30,000 Zbcn tokens. The current price is given as $0.005. In this case, the first thing we need to do is quite simple: multiply the quantity by the price. That is, 30,000 times 0.005 is $150. This represents the capital we would need to invest under today's conditions to make this purchase. From an investment perspective, $150 can be considered a low entry cost. Especially in the cryptocurrency market, low-price tokens offer investors the psychological appeal of buying large quantities. However, it's important to note that a low price does not always mean cheap or valuable. But in your scenario, we have determined a target price based on technical analysis, $0.054. Now we do the second multiplication. 30,000 times 0.054 equals $1,620. This calculation gives the total market value of our holdings if the target price is reached. Now, going from $150 to $1,620 means an absolute increase of $1,470. In percentage terms, this is roughly a 980% gain. In other words, it's almost a 10x return on our investment. This type of potential return is quite rare in financial markets and is usually possible in highly volatile markets such as cryptocurrencies. However, this high potential comes with high risk. There are a few important factors we need to keep in mind when making this calculation. First, the 0.054 target price is based on a technical analysis and pattern-based estimate. Achieving this estimate depends on certain market conditions. For example, as we discussed earlier, the cup and handle formation must be completed, the breakout must have high volume, and the general market conditions must support a bullish trend. If these conditions are met, the likelihood of hitting the target price increases significantly. Second, the time factor. Investing $150 and reaching $1,620 looks great in theory, but how long it will take is important. Some formations and market moves may reach the target within weeks, while others may take months or even years. Patient investors must be resilient against interim corrections while waiting for potential gains. Third, intermediate resistance and support levels. The price will not move in a straight line toward the target. There are many obstacles, resistances, and pause points, supports, along the way. It's natural for the price to stall or pull back slightly at these levels. The investor should not panic during this process and should stick to their strategy. Now, let's evaluate this scenario from a psychological perspective. The human brain is quickly motivated when it sees the high return potential of low-cost investments. The thought of, I'm investing only $150 and maybe I'll have $1,620 sounds very appealing. However, this appeal hides a risk factor, because before reaching the target price, there may be pullbacks and the value of the investment could drop significantly in the short term. That's why when making such an investment plan, it's necessary to set stop-loss levels. For example, if the price falls below a certain level, an exit can be made to limit losses. Also, in these types of investments, diversifying rather than tying up all capital in a single asset reduces risk. For a small amount like $150, this may not seem very critical, but it's still not wise to invest a large portion of your total investment budget in such high-risk assets. Mathematically, turning $150 into $1,620 provides a 980% return. This is a very strong increase in terms of compound returns. If we could achieve such a gain several times in a row, our capital would grow exponentially. However, since such consistent and guaranteed gains do not exist in the markets, each opportunity should be analyzed separately and the risk-reward ratio should be balanced. Here, it's worth mentioning the risk-reward ratio. The risk-reward ratio is the ratio of the targeted gain to the loss one is willing to risk. In your scenario, the target gain is $1,470. And let's say the loss you are willing to risk is $50. In this case, the risk-reward ratio is at an extraordinarily high level of 1 to 29. Such a ratio is considered very advantageous in technical analysis-based trades. Now, let's test the scenario with different price changes. Let's say it reaches half the target price, $0.027. In this case, 30,000 times 0.027 is $810. This is still a gain of over 440% compared to the initial investment. So even if it doesn't reach the full target, the investor would still make a significant profit. In investor psychology, locking in profits is a very strong urge. Most investors take profits at half the target or at a certain percentage and then make the remaining position free. This brings the investment's risk down to zero. For example, if your $150 investment reaches $810 and you withdraw $150, you can wait for the target price with the remaining amount entirely risk-free. Finally, let's evaluate this scenario from a long-term investment logic. Since the crypto market is highly volatile, large drops and rises can occur in the short term. However, if strong formations in technical analysis and the market trend are in your favor, such investments can have significant profit potential. The important thing here is to act according to a plan, not get carried away by emotions, and never neglect risk management.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.